In this video, I'm going to teach you why passive investing is so dangerous in 2024 and beyond. One very popular S&P 500 index fund today is SPY. And these are the top 3 holdings of that. So you're investing in 500 companies. However, over 7% is Microsoft, over 5% is Apple, and over 5% is NVIDIA. In total, this is 18% in just 3 companies. So let's say you have an extra $1 billion going into SPY. Well, that fund has to spend $180 million of that buying shares of Microsoft, Apple, and NVIDIA, which pushes the price of these up even further. And since the prices of these got pushed up even further, well, then they have to buy more of it. And then retail investors see the prices being pushed up even more, and then FOMO kicks in, and then they buy more of it because they want to get in on the action, and they want some of these gains that they're seeing because all their friends are saying, hey, look how much money I'm making in the stock market. I bought Microsoft, and look how much money I made. I bought NVIDIA, and look how much money I'm making. So then their friends buy it, and then their friends buy it, and then it pushes the prices of these stocks up even more, and then, because the prices of these go up even higher, well, SPY has to buy even more of it. And then after SPY buys more of these stocks, well, then you have more FOMO from the retail investors pushing the stock prices up even further. And this cycle pushes these top stocks up further and further and further. This is going to break. It will break. And what happens when this does break, when this ends, this whole cycle reverses. In 2012, about 21% of the money in the US stock market was invested in index funds. However, today, now, that number is greater than 50%. Now, passive investing works great when only 21% of the market is doing it, and the other 80% is actually doing research into the companies and digging into their financials and really thinking about what's going to be happening in their future and studying the companies like crazy. However, when you get to the point where more than 50% of the money is going into passive investing, that means fewer and fewer people are doing the actual work required to determine whether an investment is a good one or not. And the higher this number becomes, the more dangerous index fund investing is. Now, I say passive investing sometimes, I say index funds other times. Think of those two things as the same thing. Let's look at this using a chart. So here on the left-hand column, we have the risk level in the market. And here on the bottom, we have the percentage of money that's investing in the stock market using passive investing. You might think the line of this graph looks like this. It's a straight line up. The more people who are doing passive investing, the more risky it gets because you have fewer and fewer people who are actually doing the research into the companies. However, it's not like this. This graph does not look like this. The reality is this. The line starts off really low and it's not risky at all for a long time. And then after you get a certain point, it starts going up, but it starts going up exponentially. And as more and more money goes into passive investing, the risk increases exponentially and it looks like a hockey stick at the end. I estimate that we're somewhere between here and here. We're right on the cusp of that hockey stick breakout in terms of risk. Now, let's look at what's going to happen when this breaks. The most popular way to invest in an index fund is to invest in one that tracks the S&P 500. Basically, what the S&P 500 is the 500 biggest publicly traded companies in the United States that are also profitable. And when you invest in one of these funds, you might think that you're buying 0.2% of every stock in the fund. Because you take the amount you're investing, you divide that by 500, you might think they're being split equally between each of the 500 companies in here. But that's not how it works at all. What it is, it's market cap weighted. So the bigger the market cap or the value of the company, the more money of yours is going to be invested in that. So you have very, very little of your money being invested in like 400 of these companies, and then a lot of your money being invested in 100 of them. As a matter of fact, the top 15 stocks in the S&P 500 make up 38% of the market cap. So if you invest, let's say $1,000 in an S&P 500 index fund, thinking that you're going to be spread across all those 500 companies pretty equally, you're actually putting 380 of your $1,000 into the top 15 companies. Over the past 90 years, the price to earnings ratio of the S&P 500 has averaged about 15, meaning that if the companies in the S&P 500 paid out 100% of their earnings as dividends, it would take you 15 years to recoup your money. But of course, over the years, there's times of undervaluation and there's times of overvaluation. So you have a 15 average right here, and then it can spend many years below this average, and it also can spend many years above this average. But when looking at a very long-term chart, the average is about 15. Well, what do these top stocks have? Microsoft has a PE of 38, meaning that if Microsoft paid out 100% of its earnings as dividends, it would take you 38 years to get your money back, which is a good sign that it's pretty overvalued. And Apple has the lowest PE of these at 27, and then Nvidia is at 75. Now, there can be reasons for having a high PE. For example, if the company is going to grow like crazy in the coming years, sometimes investors will give it a premium PE ratio. Or, for example, if the company spent a lot of money investing in a big growth project one quarter, that might bring their earnings down for that quarter. However, that investment will increase their future earnings. But if you look at the biggest components of the S&P 500, almost all of these companies have very high PE ratios, which is clearly unsustainable. And right now, we're way up here on this chart, and we're bound to at least return to average, but usually it falls way below average. It doesn't just stop at 15. So these companies, they have a long way to fall. And what's going to happen when these companies do start falling in price? Well, then you'll have some investors who are like, hey, I'm going to take some profits here. We're already down 15%. I'm going to get out while I still have a big gain. And them getting out means they're selling, which means it's pushing down the price even further, and then more people get out. And then as more people exit, these index funds have to sell their Microsoft, they have to sell their Apple, they have to sell their Nvidia. And then that pushes the price down even further, and then more people are like, oh no, the price is down 25%. I'm going to get out while I still have a gain. And then that pushes the price down even further, and then SPY has to sell even more. That pushes the price down even further. And as you can see, now this cycle that pushed these prices way up is working in reverse, and the prices of these stocks are crashing and crashing hard. It's a very strongly held belief across many people in society in the US that the way to go, the way to invest is through passive investing, because over 30 years, and back even further actually, the average return has been greater than 10%. 10.26% to be exact. And for every $10,000 you had invested 30 years ago in the S&P 500, you would have $187,000 today. So people see these numbers, like people are watching TikTok and they see videos about this and they're like, oh my gosh, I need to do this. I need to invest in these index funds. So in 30 years, I can be rich and I can have lots of money. And with this cycle that has pushed these prices of these stocks way up, and with these price to earnings ratios bound to correct, we are going to have a gigantic reversal of this. But not only that, a majority of the money today is invested passively. The average person is not doing any research to find out which one is a good investment, and they're not hiring anyone to do that research for them. Like, you don't have to invest in an index fund. If you're like, hey, I don't know enough to do this research, so I'm just going to invest in an index fund, well, there's actually mutual funds you can invest in where you have a team of highly qualified people doing all of this research for you. And it's my opinion that although index funds on average have outperformed mutual funds on average for the last few decades, that is about to reverse. That's going to flip, and highly qualified active investors will be greatly outperforming the index funds in years to come. I see a lot of risk right now in 2024 in passive investing particularly in the US market. Now, there's lots of foreign markets that don't have crazy valuations like this, and most index funds are indexed to US markets. So the foreign index funds aren't nearly as popular, which actually, ironically, makes them much more safe. Now, I believe there will be a time in the coming years where investing in a US index fund is a great investment once again, because it is so popular today and these companies are so overpriced. The biggest holdings in these index funds are so greatly overpriced that they're going to collapse like crazy at some point. And when that happens, there's going to be a lot of people who lose a lot of money because they were invested in those index funds, and they're going to swear off index funds for life. They're going to be like, these people who promoted these index funds are liars. They're full of it. This is garbage. I am never doing this again. And then we're going to get to a point in the market where there's so many people who have that mentality, who absolutely hate index funds. And when your brother and your mother and your friend and your Uber driver are telling you how bad of an investment index funds are and that they'll never do it again, that's when you know it's a good time to get back into index funds.